Today I'm going to tell you the UK stocks I'm buying right now in my investment ISA and also my SIP. I'm also going to be talking about a range of companies such as Ted Baker, JD Sports, Boohoo and also JP Morgan, alongside the comment of the week, which is targeting index funds this week. And I felt it to be particularly relevant given the topic of the channel and how I believe picking individual stocks can outperform the markets. So if you like this video, please try one of these to help beat that YouTube algorithm, as it is much appreciated. So the first item of news is that the JD Sports boss quits with immediate effect. And you might go, okay, so what? Insiders leave all the time. But it's interesting to see that this person has led JD Sports since 2004 and is stepping down with immediate effect. Now, Mr. Cowgill here had actually held two roles since 2014, in which he was both the chief executive and also the chairman, I believe, the chair and the chief executive, which had led to some governance issues, meaning controlling the business becomes a little bit more difficult, especially as the company has scaled up significantly over his tenure. The problem with this is that it becomes much harder to regulate in a way, and you want your business to be controllable. You don't want an individual with too much power in the business that therefore can start giving themselves first class flights and all of these extra expenses, as they may not have anyone powerful enough to challenge them on their decisions. Hence an importance of obviously a board of directors and many individual board groups that you may find useful in a business. But he is also at the age of 69, had previously resisted the moves by the board to split the roles, and therefore it's a little bit interesting here. And this is under the fact that there was a review of the retailer's internal governance. Furthermore, obviously, we knew about the fines earlier in the year between JD Sports and Foot Asylum for £5 million, and there was a bit of a shareholder revolt against Cowgill himself, as he had been paid nearly £6 million in bonuses, despite accepting £100 million in government support. So this one is certainly heating up a little bit. The shares are remaining quite consistent, so that one isn't too much of a problem. But I wonder what your views are. Is this an individual that might lead a concern into the business because of his stepping down just after such a long tenure? Is it simply time where he's quit the game? He's done very, very well and decided, you know what, I'm going to quit while I'm ahead? Or, I don't know, what do you think? Leave a comment in the description down below, or in the comment section, not description. I'm not with it today. We've got Ted Baker. Now, their full year losses narrow as their revenues rise. Now, they've got the stats here, although I prefer to look at the tables. And quite interestingly, the tables present quite a lot of data. So this is cropped slightly. I'm just going to drag this over. Excuse the fact that it's very small. This is on their website itself. Maybe I'll zoom in slightly for you. There we go. That should be a lot better. Now, they've seen group revenue at a constant currency basis improve by 23.2%, which in my opinion is very impressive for a retailer, bearing in mind. And I think Ted Baker, I believe they go for a lot more as, well, as far as I'm aware, they're more of a fashion brand, or at least an accessory brand. And I always thought they were more to the premium side of the spectrum. For instance, they'd be a bit more on the pricier side. They weren't obviously high quality luxury goods, but they were certainly up there in comparison. So especially as we see a cost of living crisis occur, we can see actually some resilience here that Ted Baker has. Now, this business was previously a dog in the markets, especially over 2020, in which they struggled significantly. Now, what I find interesting here is, yes, they've got some good results here. They're certainly seeing a massive reduction in their loss before tax of about 59.1% change, or now they're only losing £44.1 million compared to £108 million this time last year. But interestingly enough, if we look at this small table here, they're talking about the quarter one trading update for the 12 weeks to the 22nd of April. So some very recent data here. They've mentioned as a group, their obviously revenue has improved by 20%. However, look at the e-commerce growth, right? Yes, you can compare it to 2020. 2020 is quite an anomalous year, or this might actually be the year before the pandemic. Regardless, during this time, they have lost e-commerce market share, as that is down a significant amount. When you compare this time this year to this time last year, or that's a confusing way of putting it, like for like basis, their e-commerce sales are down 36%, which is something to consider here. This is showing that, okay, look, they're doing quite poorly online. However, their stores themselves have improved by 137%, assuming there was no trading disruption, obviously, at that time period, which I imagine there could have been, as I don't really remember the last lockdowns and when they were. It's all a bit of a blur nowadays. But it's certainly one to be watching. I've not really dived into the balance sheet. The detail is probably a lot further down below. But I've always liked Ted Baker just from the type of goods they've provided, and it's just interesting to me how to see the competition competition, how it goes. Now, JP Morgan has said here, let me just adjust the screen ever so slightly, that they've boosted their earnings forecast for 2022. This is because they expect, and this is the important thing here, they assume that the Federal Reserve will increase short-term rates to 3% by the end of the year. So that is about just over 6 months to increase interest rates to 3% by the end of the year. Now, I can't remember off the top of my head what the rate is in either America or the UK at the moment. To be honest, my mind is blank. I want to say it was around 1 point something percent, but again, it's completely gone. It might not even be that high just yet. But that is a significant move from whatever it was. It definitely was not in the 2s, and I think it was just about in the 1% category. I don't know about America. So to have 3% by the end of the year is a strong move. And obviously, as interest rates rise, it becomes more difficult because obviously more investors are saving rather than investing. Share price is going to have a bit of a hit here, and especially with the inflationary gap and obviously this cost of living crisis, it now means that inflation is soaring, interest rates are rising, people are less likely to be spending money, therefore they're going to put their money in their savings account. So times will be tough, but a company like a bank themselves, obviously they're set to do quite well, and their return on tangible capital equity is a 17%, or common equity, sorry, is a 17% maintained medium target for return. Now, Boohoo. Now, obviously, I'm going to talk about Boohoo as I hold a lot of shares in Boohoo, in my opinion, compared to my relative net worth. They've now reached a final settlement in the US class action claim. Now, this had tons and tons of fear back, let's say, a year ago at this point, where there was the incident where the promotions were misleading. Boohoo is a business that primarily focuses on sales. They're trying to get you to buy. I mean, the the chairman and founder of the company had said this himself alongside a trend of emails that were obviously exposed, saying it prioritizes sales, sales, sales. Therefore, on the apps, I don't know if you have any of the Boohoo related apps or any of their group branded apps or websites, there is always a promotion ongoing. However, the belief is here in this class action lawsuit is that the person was missold. That actually these products were never intended to be sold at the true retail value, and therefore obviously they felt that this was unfair and therefore put a class action lawsuit against Boohoo. Boohoo had agreed to a settlement saying, you know what, let's not take this further, let's keep it out of the courts, we will pay you a certain amount of money, and therefore they provisioned for an amount in November 2021, and the amount they provisioned was within £17.8 million. And they've said that it's going to stick to that, which is a promising sign. It's saying the individual isn't trying to push for a lot more, and that in this situation, Boohoo could even have a better outcome than is expected. And to see this, whilst obviously their balance sheet has reduced significantly down to £1 million in net cash, suggests, even though they have got the revolving credit facility available, £325 million that is undrawn, it suggests that actually, okay, look, the position is okay. Now they haven't got any external factors impacting the business at the moment. It's just a case of dealing with the industry-wide concerns and the supply chain disruption. I did also commentate on the THG, or the Hut Group's founder, and his bold moves on why I don't really agree with them, and there's a link to the video at the top right. The comment of the week suggests, and this is from Ali, says, you really need to stop going in and out of stocks, buddy. Just invest in an index fund. That is the best strategy for the ordinary investor. I completely agree. I think if anyone's going to invest in the stock markets, looking for a globally diversified index fund is a very strong strategy for the longer term. I've more recently been switched onto the idea of the S&P 500. I don't know if you need much more than that due to the requirements and prerequisites, of getting into the S&P 500. I think therefore holding a diversified fund obviously is a great way of getting long-term growth with minimal time investment, only money. Obviously, the longer term time is what you're after to invest for, but the initial research stage can be done very, very fast in a couple of hours to identify which index fund is fine for you. Whereas investing in individual stocks and shares requires consistent, regular research and a lot of research up front to identify, okay, is this business an effective value where I would buy now and get a good return on investment over time? Or in hindsight now, obviously I bought Boohoo at £2 something a share, £2.70 I think I first started buying Boohoo at. Did I really run the maths here? Were my valuations correct? Because since then, it's dropped to about 80 pence per share and even lower before. So therefore, I made a mistake because I did not value the business properly, even though it's easy to know that in hindsight. There's a lot of factors at play here, not even just valuation, but quality of business as well, which a lot of time, energy and money needs to be put into, which is something I felt I had an advantage with because I'm young. I had a lot of free time at the time, hence why I created the channel, especially in the lockdowns. I was able to do significant amounts of research where other people had other things that their time took. They might have had children, they might have had other things, or working a very, very intensive job, whereas at the time I was furloughed from a pub. It gave me complete and dedicated focus. And it's kind of like when you see a kid, for instance, and they're entering a sport, or there's a 13-year-old that's started doing karate. They have the time and energy and focus, the motivation and discipline to sit down and just do it, right? And that kind of energy is sort of what I had back in the lockdowns of the pandemic. It allowed me to do lots and lots of research. Now, I'm not saying I'm fantastic, because quite frankly, I'm not. And I still have significant amounts to learn in the markets. But I do believe that I have formulated a strategy which I think is quite good. I do need to do a lot more work, especially on the valuation aspect, as I mentioned earlier. But I believe it is possible over time to outperform the index funds with a very strongly built strategy. Mistakes I make along the way are something that I could learn from and therefore use in the future as my strategy adapts and develops. Now, Ali continues to mention, over the longer term, it's a guaranteed return ever since the inception. No one has ever beat the market. Even if they have, the everyday investor will not over the longer term. Now, I disagree with this. There's a lot of people that have actually beat the market. Warren Buffett, Peter Lynch. There's many individuals that you and I haven't heard of, for instance, that have beat the market over the longer term. I think a good example as well is like Nick Sleep and Zakaria, or quite Zakaria, I can't say his first name. They had beat the market over their time. A lot of fund managers, successful ones, famous ones that you would know of, had beat the markets over their tenure and stopped. And you might go, well, that's not good enough. If they only were a fund manager for 10, 15 years, that's not long-term enough. Therefore, they would never have beat the market. But the best real example of that is Berkshire Hathaway, Warren Buffett and Charlie Munger. They have beat the market over the longer term. Sure, they're not winning just on a year-by-year basis, but over the longer term, they certainly have. And therefore, I feel that if you want to beat the market, if the average investor underperforms, you therefore don't need to conform, or you shouldn't want to conform with the average and sort of plot your own course and do almost what the opposite of the average does in order to make good returns. At the moment, many investors are flocking towards oil. Many investors are flocking towards energy, and perhaps is it financials? I can't quite remember. Value stocks with high amounts of cash flow. If the average investor is pouring their mind into this, and these valuations are going up at the moment, and these value investors are doing well at the moment, would now be a really good time with the growth stocks that are so beaten up, they're down 60, 70%, would now be a good time to switch from the value stocks slowly and steadily into the growth stocks, slowly trimming away the profits in the value stocks and really averaging yourself down into the growth stocks, so that when the cycle switches again, you would become in favor. Obviously, you would have to invest with a longer term mindset, but in my opinion, I think this would be a very effective strategy of developing longer term returns. Obviously, if the value stocks still have growth potential, then why sell them, of course? But again, I think that comes to mind, and I think that could be an optimal strategy in beating the market. But what do I know? I'm significantly down. You can see my portfolio here with Freetrade. You can see the numbers are correct because this is on Freetrade's website. I'm not lying to you in any way, shape or form. And yes, I am down 44% on my investment with Boohoo. I'm down 21.85% with my investment in Games Workshop. When we look actually at my portfolio, I'm down overall by 41.29%. This is a significant amount, and therefore means that over my time frame, whereas all of the index funds or the indices that we can track against in the markets have outperformed me. Therefore, no one should listen to me. But if there's one thing I should say, I feel that, quite frankly, you can learn a lot from the winners in the markets, but you could also learn a lot from the losers. And I feel whilst I may not have much of value to offer, I think I'd want to study the strategy of the person that is losing and avoid exactly what they do, right? So therefore, in the short term, I am underperforming, but I do think you should stay tuned and keep around. Let's see what happens over 5-10 years, of course, if you have the patience for that. I've also been making some buys in my self-invested personal pension. Now, the value of this pot is about £1,180. It's unlikely to really increase that much over the next year, because my attention is focused on my ISA, and I'm also making some property investment in the southwest of the country that I do think is of interest, and I will be updating you on at some point once we're getting a little bit closer to the desired time frame. But I've been buying a bit of Dunham Group here, averaged down my position. I think it's a very quality company. It's not something that's going around or going away anytime soon. They've got plenty of cash flow, and their debt is underneath a point fraction of their EBITDA, or their earnings before interest, taxes, depreciation, and amortization. Therefore, I think they're in a good position. But I also bought shares of Kingfisher, and I will be talking about them next week in one of my videos, because I do think there is some good value here, even if their growth isn't going to be too much. Because in my SIP, I'm focusing on value-orientated dividend stocks with high amounts of cash flow, with a little bit of growth over the future, but also the really good, strong dividend yields and growth over time. So if you like this video, thank you for watching. Have a fantastic day.